In 1994, Jeff Bezos drove across America in the passenger seat of a car, writing a business plan on his laptop while his wife drove. He had just quit one of the most prestigious jobs on Wall Street. His boss tried to talk him out of it. His colleagues thought he had lost his mind. His parents invested $250,000 and privately expected to lose every dollar. Amazon lost money for 20 consecutive years. 20 years. Wall Street called it a charity, a vanity project, a tech company cosplaying as a retailer that would never turn a profit. Then something happened. Quietly, almost invisibly. While everyone was watching Amazon deliver packages, Amazon was building the backbone of the entire internet. Today, if Amazon's servers go dark tonight, Netflix stops working, Airbnb goes offline, the CIA loses access to its own classified systems, half the websites on Earth disappear, and almost nobody saw it coming, because they were all looking at the boxes. This is not the story of a web shop. It was never the story of a web shop. This is the story of how a man selling books from a garage built the most quietly powerful company on Earth, and why most investors still do not understand what they're actually buying. Chapter 1. The Retail Trap. Let's start with what everyone knows. Amazon sells things online. And if you only look at the retail business, the stock makes absolutely no sense at current prices. Retail margins are razor thin. Competition from Walmart, Temu, and Shein is intensifying. Amazon actually loses money on many direct retail sales. So why is it worth over $2 trillion? Because the retail business is not the product. It never was. The retail business is the distribution network for the real product. A Trojan horse, hiding what Amazon was actually building inside millions of cardboard boxes. Every package delivered builds the logistics infrastructure. Every Prime subscription locks in a customer. Every warehouse positions the company closer to same-day delivery. The retail business is a moat-building machine, not a profit machine. And here is the part most people miss. Amazon has over 200 million Prime subscribers globally, each paying roughly $139 per year in the US alone. That is $27 billion in recurring subscription revenue before they buy a single thing, before a single box ships, before a single driver starts their route. Bezos was not building a retailer. He was building a subscription business disguised as a retailer. And almost everyone missed it. Chapter 2. The Empire. Nobody saw coming in 2006. Amazon launched a service called Amazon Web Services, a WS. Nobody paid attention. Amazon was a bookstore. What did a bookstore know about enterprise cloud computing? Turns out, everything. A WS is now the world's largest cloud computing platform. It powers roughly 31% of the entire global cloud market. More than Microsoft Azure. More than Google Cloud. When you use Netflix, Airbnb, Uber, LinkedIn, or thousands of other apps, you are almost certainly running on Amazon servers without knowing it. AWS generated $107 billion in revenue in 2024, growing at 17% year over year. Its operating margin is approximately 37%. Compare that to the retail business, which operates at roughly 5% margins. Here's what that means in practice. AWS is the engine that subsidizes everything else Amazon does. Without AWS profits, Amazon could not afford to lose money on retail, fund Prime Video, invest in Alexa, or build out same-day logistics. Bezos understood something that almost nobody else did in 2006. The future of computing was not software you installed on your computer. It was computing power you rented from the internet. He built the infrastructure for that future a decade before anyone else took it seriously. The bookstore was never the point. A WS was always the point. Chapter 3. The Advertising Empire. Nobody talks about. Here is something that will surprise you. Amazon is now the third largest digital advertising platform in the world, behind only Google and Meta. Most people have no idea. Amazon advertising generated over $56 billion in revenue in 2024, growing at 18% year over year. Think about what that means. When you search for a product on Amazon, the results you see first are paid placements. Brands pay Amazon to appear at the top of search results. And because Amazon search has purchase intent, people searching on Amazon are ready to buy. The conversion rates are higher than almost any other advertising platform on Earth. This business did not exist in any meaningful way 5 years ago. It is now larger than the entire advertising revenue of YouTube. Amazon turned its search bar, the thing you use to find toilet paper, into a $56 billion advertising machine. and most people using it every day have no idea they are looking at paid results. Chapter 4. The bets nobody is pricing in. Anthropic. Amazon has invested $4 billion in Anthropic, the AI safety company behind Claude. This is not just a financial bet. Amazon gets preferential access to Anthropic's models for AWS customers. Every company that builds AI applications on AWS and uses Claude is generating revenue for both companies simultaneously. Amazon is positioned at the center of the AI value chain, regardless of which model wins. Trainium and Inferentia, custom AI chips. Amazon is no longer dependent on NVIDIA for AI compute. AWS has developed its own custom AI chips, Trainium for training and Inferentia for inference. These chips are significantly cheaper than NVIDIA's equivalent offerings for certain workloads. As AI inference costs become the dominant compute expense, Amazon's ability to offer cheaper AI compute than competitors is a structural cost advantage that compounds over time. Kuiper, satellite internet. Amazon is building Project Kuiper, a constellation of 3,200 satellites designed to compete directly with SpaceX's Starlink. The first production satellites launched in 2024. If Kuiper reaches operational scale, Amazon gains a direct-to-consumer internet service that bypasses traditional telecoms entirely. Another trillion-dollar addressable market that barely exists yet. Zoox, autonomous vehicles. Amazon acquired Zoox in 2020 for $1.2 billion. Zoox is building a fully autonomous robo-taxi, purpose-built with no steering wheel, designed exclusively for autonomous operation. If it works, Amazon enters the ride-hailing market with a vehicle built from the ground up for autonomy. None of these alone justifies Amazon's current valuation, but together, they represent a portfolio of bets across the most important technological transitions of the next decade, the same pattern that defined Amazon's first 30 years. Amazon is not betting on one future, it is betting on all of them simultaneously. It always has been. Chapter 5. The moat. Amazon's moat has 4 layers, each one reinforcing the others. The flywheel. More customers attract more sellers. More sellers mean more selection. More selection means lower prices. Lower prices attract more customers. This self-reinforcing loop has been running for 30 years and gets stronger every year. Prime lock-in. Prime members spend on average $1,400 per year on Amazon. Non-Prime members spend $600. Once you are in the Prime ecosystem, the free shipping, Prime Video, Prime Music, Prime Reading, leaving is psychologically costly, even if a competitor offers lower prices on individual items. Bezos didn't build a store. He built a habit. Logistics infrastructure. Amazon has built the most sophisticated logistics network in history. Over 1,000 warehouses globally, its own airline, its own delivery fleet. This took 30 years and hundreds of billions of dollars to build. No competitor can replicate it. Not in 5 years, not in 10 years. Maybe not ever. Data. Amazon knows what 200 million people buy, when they buy it, how much they pay, and what they search for. That data makes AWS more valuable, advertising more targeted, and product recommendations more accurate. It compounds with every transaction, invisibly, automatically, permanently. Chapter 6. The bear case. The bear case is real and deserves to be taken seriously. Amazon's valuation assumes AWS growth continues at double digits indefinitely. If cloud growth slows, if enterprises cut spending or competition from Microsoft and Google intensifies, AWS margins compress and the entire investment thesis weakens. The retail business faces genuine structural pressure. Temu and Shein are acquiring customers at prices Amazon cannot match in certain categories. Chinese manufacturers selling directly to consumers bypass Amazon entirely. And regulatory pressure, antitrust investigations in the EU and US, could force Amazon to separate its businesses or limit its ability to favor its own products in search results. Andy Jassy has executed well since replacing Bezos as CEO. But Bezos was Amazon in the same way Jobs was Apple. The founder effect is real. The vision that built a bookstore into the backbone of the internet came from one person. Whether that vision continues without him is an open question. And then there is the capital intensity. Amazon spent $83 billion in capital expenditure in 2024, largely on AWS data centers and AI infrastructure. Free cash flow, while growing, is being consumed by investment. If those investments do not generate the expected returns, the valuation looks very different. Chapter 7. What is it worth? At 35 times forward earnings, the market is pricing in continued double-digit growth from AWS, advertising sustaining above 15% growth, and retail margins slowly improving as logistics costs decline. The bull case, AWS becomes the default infrastructure for AI workloads. Advertising grows to rival Google, Kuiper disrupts satellite internet, and Xerox cracks autonomous vehicles, justifies the current valuation and potentially significantly more. The bear case, cloud growth plateaus, antitrust forces structural changes, and the $83 billion capex bet takes longer to pay off than expected, suggests the stock is priced for perfection in an imperfect world. Morningstar's fair value estimate for Amazon sits around $215 per share, roughly in line with current trading levels. That suggests the market has priced Amazon fairly, not a screaming buy, and not dramatically overvalued. The key variable is always AWS. If cloud computing growth accelerates with AI, Amazon is cheap. If it plateaus, Amazon is expensive. In 1994, a man drove across America writing a business plan that his colleagues thought was insane. He was going to sell books on the internet. 30 years later, that man built the infrastructure that runs half the internet, the third largest advertising platform on Earth, a $27 billion subscription business, and a portfolio of moonshot bets that most analysts are not even pricing in. The retail business is not Amazon. It never was. It was the box that hid what Amazon was actually building until it was too late for any competitor to stop it. The business is extraordinary. Now, the question is whether the price already reflects that.